Welcome to SB Talks. Today is Monday, September 9th, and I am joined as ever by our trusty Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Today, Nick and I will be discussing global growth déjà vu, Australian GDP weakness and the RBA outlook, as well as running through portfolio positioning for the back end of 2024. Welcome to all our listeners. Now, the last week, the start of September, feels a little bit of a déjà vu to what we experienced in late July and early August. Global growth concerns kind of back top of the agenda.
Yeah, no, it was a negative week for equity. So the Nasdaq was down 5.8% last week, which was the worst week since January 2022 when the Fed started lifting interest rates and said inflation was no longer transitory. So S&P down 4.2%, very much a risk-off week. Oil down 10%.
Right.
Iron ore down from $100 a tonne down to back to around 90. So quite a lot of concerns around growth slowdown. Any
particular data or information points there that are driving those concerns?
Yeah, so there was a lot of attention on the Friday night's non-farm payrolls report for August in the US. And even though the report itself wasn't too bad, it was 142,000, so a little less than the 160 expected. And the unemployment rate ticked down from 4.3 back down to 4.2%. It was really the negative revisions to prior months. So July's figure was revised from 114 down to 89 and June's from 179 down to 118. So
it's quite a consistent trend. We've seen these regular revisions down of the prior months.
Yeah, and I think that's what the concern is. So even though 142 wasn't too bad, it's like, well, maybe this gets revised away. So I think there was a bit of concern. The 3-month average employment growth is about 116,000, and that's the weakest since sort of 2020. So definitely, slowdown in employment. There was a bit of reversal in those temporary layoffs that we've spoken about before that caused the unemployment rate to spike last month. So that was good. But the market, was I guess disappointed, and so we saw a bit of a sell-off there.
And we've talked before that the market, for particularly some of the names, technology names, the Mag 7, the market had priced them for something of perfection. So it doesn't probably take a lot of negative sentiment to sort of start to weigh on some of those prices.
Yeah, so the Mag 7, I'm not sure up until Friday, but when I wrote the monthly, they'd underperformed the broader market by 14 percentage points since mid-July. So real rotation going on in markets. So, sectors or styles such as minimum volatility, value stocks have outperformed, and momentum-driven stocks, those that have gone up in price, have reversed, and growth stocks reversed, really driven by the Mag 7 underperformance. So some rotation going on in markets as investors maybe look to reposition their equity portfolios to be a bit more defensive. We've seen things like property and infrastructure actually do reasonably well because I guess they're less cyclical stocks. Yeah.
Less dependent on the consumer.
Yeah, more defensive earnings. So I think that's been an interesting development. In terms of the Fed, so the Fed meeting on the 18th of September, market pricing hasn't really changed. So we're still around that sort of 32 to 33 basis points price. So really there's not a lot of consensus around whether we get a 25 basis point cut or a 50.
Yeah, so I think the last time we recorded was just after Jackson Hole Symposium, and you were saying there was really a clear marker at that point that we were heading into the cutting season. So now it's more the debate of the degree to which they start to cut.
Yeah, and we had a couple of Fed officials talk to the media and to the market after the non-farm payroll. So the Fed Governor Waller and the New York Fed's John Williams. And sort of if you look through what they said, I think the takeaway is probably 25 basis points, but they are saying they're a bit more concerned about the what's going on in the labour market, and they wouldn't dismiss a 50 maybe at a subsequent meeting if the data justified it. So Fed Waller said he'd be very happy to front load rate cuts like the way they front-loaded rate hikes on the way up. He'd be happy to do it on the way down if the data justified it. So I think, they're leaving the door open for a double rate cut sometime before the end of the year. So that's why the market's still sort of roughly priced where it was for 4 cuts by the end of the year, even though there's only 3 meetings.
Yeah, and obviously a particularly sensitive time politically there as we sort of head into the final lap of the US presidential election. So there is that sort of extra degree of tension around it all.
There is, but you don't get a sense from particularly from the Fed officials that they're focused on that. I mean, it's very much, worrying about the labour market and things like that. We do get another US CPI print this week. People are looking for a 0.2% rise. Potentially if it was really weak, it might marginally tip them towards a 50 basis point rate cut, but probably not likely. So I think that's kind of where we're heading. We've got the ECB meeting this week as well. They're largely expected to follow up their June rate cut with another one. Market's really focused on, what the commentary is for the rest of the year, whether there'll be further rate cuts from them. Yeah.
Closer to home, we saw some more GDP data released recently since we last recorded, and it just continues the trend of pretty sluggish growth and as you talked about previously, the per capita recession.
Yeah, so it was the 6th quarter of negative GDP growth per capita. And overall, at 0.2% quarterly growth and 1% for the year, it's the slowest growth in 32 years outside the COVID pandemic. So really quite weak. When you drill into the details, household consumption actually fell 0.2% over the quarter. And outside the pandemic, that's the weakest since the GFC, or the largest decline in quarterly consumption growth from the households. So really, consumers just not opening their wallet, contraction in spending, given population growth, that's quite unusual to have it fall, even though, the number of people is expanding.
Yeah,
so,
and clear evidence, obviously, of the rate increases that have taken hold are having some impact on the households. We've talked previously about the sort of pandemic savings being sort of beginning to run down.
Yeah,
it's definitely a two-speed economy with certain households feeling the pain.
Yeah, so the savings rate fell from 0.9% to 0.6%. That's pretty weak. Some people say, it should be around 5%. People should be saving about 5%, 5 to 10, and so we're, not even, barely positive. So that's weak. And then, for the RBA. Productivity growth of just 0.4% for the year sort of doesn't really get them too excited.
It's a pretty consistent theme on that front, unfortunately.
Unit labour costs are now 5.8%, so that's something that they definitely focus on, saying, well, that's not really consistent with inflation being at that 2 to 3% when you've got wages growth, kind of net of productivity running at that level. So... yeah, so I think it's really interesting. A lot of people have spoken about the public sector, being a big driver, and they were a contributor. But if you actually look at the numbers, it's not that dissimilar to the sort of pre-pandemic period, the amount of sort of government spending and the contribution
major
to growth.
infrastructure projects.
So you couldn't really... I mean, a lot of people have said it's, the government's crowding out the private sector and it's, keeping inflation up. There's an element of that, but I think there's other things going on as well.
And with that information, how's the market now pricing where the RBA goes from here?
I think, last time I checked, there was still one rate cut priced in by the end of the year, which the RBA has obviously tried to push back on and said, well, that's really not on the agenda, given where inflation is. It hasn't really fallen this year. It's kind of hovering around that 4% level. So they're really pushing back on that. But I think the market's maybe looking at what's going on internationally, with this sort of growth concerns, saying, well, maybe they will cut. So, yeah, I think it's still a bit cloudy.
We still got a direction to travel, I think, on the inflation front before they could probably have the confidence to be making those moves, regardless of some of the clear household weakness that we are seeing.
But if you look at the economy, as I said, very weak economy. The unemployment rate's gone up 0.5% over the last 5 months, so that's kind of travelling in that direction. So, it's a bit of a stagflationary scenario that is quite challenging for monetary policy makers.
And when we last recorded, we were talking about the early stages of the local reporting season, and you spoke to BHP. Anything further that you'd add to in terms of what you saw through the reporting season?
Yeah, so overall, it's largely completed now. Earnings were down 4.6% over the year. That's the second year in a row that earnings have actually declined for the ASX 200. That said, they were broadly in line with expectations, so it wasn't a really surprise. A lot of companies had pre-announced earnings in that confession season.
And we had a bit of a taper off in iron ore and commodity material earnings there.
So the big drivers, obviously, as you said, commodities. So resources were down 17%. Their earnings were down 17% year on year. Banks down 1%, so fairly flat earnings from the banks. And it was really what we call the industrial sector. It's the non-resources, non-financial sector that was reasonably positive.
Right.
Overall, revenue growth slowed a little bit, but it was really the margin line that was disappointing. So margins had been quite high, but I guess with cost pressure, wages still kind of going up. That squeezed margins a little bit. So that's where a lot of the weakness was. Margins are back in line with the long run average. The number of companies beating estimates was 32%, the number missing 38%. So that's a sort of a beat to miss ratio of 0.8. And the long run average for that is 1.4. So it gives you a sense of kind of, it was fairly underwhelming.
Yeah.
Small caps also, they missed. So 45% of small caps missed versus 32% of large caps. So it was a third straight year of sort of small cap underperformance. So it paints a picture of fairly weak sort of earnings growth for the year ahead. Earnings have been cut from, I think it's 3.7% to just 0.4% for 2025. So there's a risk there that we get a third straight year of decline in overall earnings for the index. That said, there were some pockets of good performance. Some of the tech companies had pretty good results. And there were quite big swings, so a lot of companies, I think 35% of companies moved more than 5% up or down on the day of the announcement, which is quite high relative to kind of normal years. So
shows the market trying to get a read for the direction of travel for some of these companies and I guess for the index more broadly. When we think about summarizing some of these points, obviously some of the growth challenges globally, the rotation that we have seen in international shares, and some of your comments there regarding Australian reporting season, how does that make you think as an asset allocator? How are you feeling about the choices open to you as you position portfolios into the back end of the year?
Yeah, so sort of big picture, what does it all mean? Well, I think it paints a picture of a soft landing. I'm not concerned about a recession. I don't think there's any signs of really a sharp slowdown in the US or anywhere else really. And there's still the backdrop of inflation falling. Real wages will improve. People holding on to their, pay rises that they've got. So their spending power will improve. And as interest rates come down in many parts of the world, maybe not so much Australia, the consumer will actually be doing better. So I think the outlook is fine. And I think the rotation in markets away from that very concentrated US market, have 30% in the Mag 7.
So healthy rotation.
Is healthy.
Yeah.
Is healthy. So I'm fairly relaxed about the outlook. I mean, the Australian market, it's hard to get too excited about it, but it has been a beneficiary of inflows from offshore investors reallocating out of China. So I don't necessarily want to fight against that at the moment. But that said, we're constantly monitoring it, and potentially we could adjust our regional exposures in equities.
Excellent summary, excellent catch up as always, Nick. Thank you very much.
Thank you,
and thank you to all our listeners.